Welcome, everyone, to the Bite-Sized Tech News TLDR for this exclusive deep dive.
Glad to be here.
If you are tuning in right now, you already know our mission here. We are taking the exact same high-energy, purely analytical approach that you rely on from our YouTube channel.
Exactly.
And we are applying it right here to bring you the absolute bottom line on the most critical, paradigm-shifting tech news of the day.
No fluff.
Right, no fluff at all. We take the complex, we strip away the marketing jargon, and we give you the rigorous, digestible summaries you need to stay ahead in your industry.
And today we have a topic that is frankly going to completely rewire how you look at the current technological landscape.
It really is, because we are looking at a transcript from a recent, highly explosive breakdown titled, "Is the AI Boom a $1 Trillion Accounting Illusion?"
Which is quite the title.
Yeah, let me tell you, when I first parsed through these source materials, the sheer scale of the financial mechanics at play was just staggering. We're currently surrounded by an unprecedented volume of AI hype. Every single day, there is a new model deployment, a new promise of artificial general intelligence, a new mind-blowing earnings report from a Silicon Valley titan.
Right, it's constant.
But today, we are bypassing the press releases. We are going to look strictly at the raw math underneath that hype.
Because the math is where the actual story is hiding.
Exactly. And the goal today is to extract the pure, unvarnished facts. We aren't going to get lost in irrelevant chatter. We are getting straight to the bottom line of what this means for the global tech infrastructure.
That is the precise mandate for today. And I think it is absolutely crucial that we immediately frame why you, the listener, need to prioritize this information right now.
Yeah, why does this matter to them?
Because on the surface, a title mentioning a $1 trillion accounting illusion might sound like abstract high-level Wall Street trivia.
Right.
You might be sitting there thinking, I'm an engineer or a product manager or a creative director. Why should I care about the esoteric accounting practices of tech megacaps?
It sounds like a problem for the CFO, not for me.
Exactly. But this is emphatically not just about spreadsheet math or quarterly earnings calls. We are going to analyze the immediate, tangible productivity and security impacts that this financial maneuvering has directly on you.
On your actual job.
Yes. Think about the average modern professional right now. Think about your own daily workflow. You are almost certainly relying on these elite AI tools to write complex code draft executive reports, analyze massive data sets, and streamline your communications.
Everyone is using them.
Right. And if the financial foundation of the core tools you utilize every single day is actually built on a highly precarious mirage,
Which is what we are arguing today.
that is going to directly impact your operational bottom line, your company's future IT budgeting, and potentially the security of your proprietary enterprise data.
It's huge.
This is fundamentally about the reliability and the true cost of the tools you need to do your job.
Okay, let's unpack this, because to really understand the sheer magnitude of what we are dealing with, we have to start by looking at the initial warning signs.
The red flags.
Right, the red flags. And the sources make a point to highlight that the people sounding the alarm right now aren't just random internet skeptics.
Or rival tech CEOs trying to spread fear, uncertainty, and doubt.
Exactly. We're talking about some of the most rigorous, data-driven financial minds in the world, asking a deeply uncomfortable question.
What if this entire world-altering AI boom is currently being propped up by a remarkably simple accounting maneuver?
And the most prominent name jumping off the page in our source material is Michael Burry.
Oh, yeah?
For those following the financial sector, that name carries massive weight. The investor famously chronicled in The Big Short.
The guy who saw it all coming.
The analyst who famously looked at the booming, seemingly invincible subprime housing market, dug past the AAA ratings, saw the highly toxic math underpinning the entire system, and called the catastrophic crash before the rest of the market even woke up.
He essentially bet against the entire global economy and won because he read the actual data.
Right. When an individual with that specific track record for identifying systemic market illusions points a finger at the tech giants
You listen.
and suggests there is a massive looming problem with how they're handling their books, specifically regarding their multi-billion-dollar AI hardware acquisitions, you have to stop, put the marketing brochures down, and pay very close attention to the math.
It demands immediate attention.
Yeah.
Burry's entire methodology, his entire career trajectory, is built on finding the hidden structural discrepancies between what a highly euphoric market claims an asset is worth and what the underlying cold hard arithmetic actually supports.
He actively hunts for the illusion.
He does. And the source material highlights that to understand this potential trillion-dollar puzzle currently unfolding in the AI space, we have to grasp a core financial concept.
Depreciation.
Right. Now, we all know how standard depreciation works in a general business context. You acquire an asset, it physically degrades or becomes obsolete over time, and you amortize that loss of value over a set schedule.
Like buying a company car, it loses value every year.
Exactly. But the straight-line depreciation method that these tech hyperscalers are currently utilizing on their balance sheets assumes a server's utility decays at a steady, predictable, completely uniform rate year over year.
So it's a smooth line?
It looks like a perfectly straight, gentle slope on a graph. It is a highly predictable, clean metric that keeps the auditors and the shareholders incredibly happy.
Because it's predictable.
But for anyone who actually works in the trenches of cutting-edge technology, the idea that AI hardware decays at a gentle, predictable rate is a complete fiction.
Well, I want to push back on that slightly, or at least play devil's advocate for a moment to make sure we are rigorously testing this premise.
Go for it.
When we talk about these massive hyperscaler data centers, we aren't just talking about the silicon chips themselves. We are talking about the massive reinforced concrete structures, the incredibly complex liquid cooling systems, the massive power delivery infrastructure, the networking cables.
Like your physical shell.
Doesn't all of that physical infrastructure actually have a long, predictable shelf life? Couldn't you argue that a long, straight-line depreciation schedule makes sense for the broader facility?
That is exactly the defense you will hear from the investor relations departments at these companies. But the source material cuts right through that argument by focusing on where the actual capital is being deployed.
The money isn't in the concrete.
No. Yes, the concrete shell of a data center might last 30 years, but the overwhelming majority of the capital expenditure, the hundreds of billions of dollars we are talking about, is not going into concrete.
It's going into the chips.
It is going directly into the highly specialized, incredibly expensive AI compute clusters, the GPUs. And the reality of that specific hardware is that the value does not operate on a smooth downward slope.
How does it operate then?
It operates on a cliff.
A cliff, and the sources provide a brilliant, irrefutable piece of evidence to back up exactly how steep that cliff really is.
They do.
They bring in a direct quote from Jensen Huang, the CEO of Nvidia. And if you are plugged into this industry at all, Nvidia is the absolute epicenter of this hardware boom.
They're the ones making all the money right now.
They are the company designing and manufacturing the vital, highly coveted GPUs that power this entire AI revolution.
And what did he say?
Jensen Huang basically admitted in a public forum that the exact moment NVIDIA releases a brand new chip architecture, say moving from the Hopper architecture to the new Blackwell architecture, the previous generation of chips is essentially rendered functionally and economically uncompetitive.
Overnight.
Overnight. He explicitly stated that you couldn't give the old hardware away to top-tier research labs.
Because nobody wants it.
And here is the truly terrifying kicker for the accounting departments. NVIDIA has publicly accelerated their product roadmap.
It used to be, every couple of years?
Right, but these massive generational leaps in hardware capability are now rolling out on a one-year cycle. The innovation velocity is moving at an absolutely breakneck speed.
What's fascinating here is the massive, almost comical disconnect between how this hardware depreciation is recorded in a corporate spreadsheet versus the brutal, uncompromising physical reality of the technology sector.
Spreadsheets versus reality.
The key takeaway from Huang's statement is the insanely fast rate of obsolescence in AI hardware.
Right.
If the chief architect of the hardware, the man controlling the global supply of these chips, is telling you that the older generations are practically worthless the second the new generation drops, because the power-to-compute ratio is so drastically different.
You have to listen to him.
Then a straight-line depreciation model stretching over multiple years is completely out of touch with physical and economic reality.
It's just a fantasy.
The hardware is losing its actual functional competitive value much, much faster than the paper accounting is acknowledging.
You can't train a frontier model on old chips.
You absolutely cannot. You cannot train the next frontier AI model on hardware that is 3 years old. The power draw alone would bankrupt you compared to using the newest chip.
Because they're so inefficient.
Exactly. And when you apply that glaring disconnect to the companies actively buying these chips by the hundreds of thousands, the sheer scale of the financial problem becomes incredibly daunting.
So let's pivot our focus to those massive buyers, because we have to look at the big players. The hyperscalers.
The titans.
We are talking about the absolute titans. Google, Microsoft, Meta. These are the entities physically running the infrastructure for the entire modern internet, and they are the ones bankrolling this current AI arms race.
And they are spending a fortune.
According to the sources, these hyperscalers are deploying an absolutely staggering, historically unprecedented amount of capital expenditure on AI gear.
Billions and billions.
They are buying up Nvidia H100s and B200s by the truckload, building gigawatt-scale data centers. And the source pulls a deeply sobering estimate directly from Morgan Stanley.
And Morgan Stanley doesn't just throw numbers around.
No, they don't. Their analysts project that the depreciation costs alone, just the financial hit from this specific hardware getting old, degrading, and becoming functionally obsolete, is going to hit $680 billion over the next 4 years for these hyperscalers.
Let's just pause and thoroughly examine that metric. $680 billion.
It's almost unimaginable.
To put that in perspective, that is roughly equivalent to the entire gross domestic product of several developed nations.
Wow.
That is not the cost of funding new experimental AI research. That is not the payroll for their tens of thousands of elite engineers.
No.
That is not marketing spend. That $680 billion is purely the financial weight of their existing, currently operational equipment decaying in value over a relatively short 4-year window.
Just rotting away on the racks, essentially.
It is a financial burden that is almost impossible to fully comprehend. And here is where the accounting mechanics become critical.
How?
Because how these hyperscalers choose to legally account for that $680 billion on their income statements has a massive, immediate, and direct impact on the profit numbers they report to Wall Street every single quarter.
Oh, right. If they take the hit all at once, it looks terrible.
Exactly. If they were forced to take that massive depreciation hit all at once, matching the rapid physical obsolescence that Jensen Huang described, their quarterly profits would look absolutely disastrous.
Stock prices would tank.
The narrative of the AI boom would suddenly look like a massive uncontrollable capital incinerator.
A money pit.
So predictably, the executive suites at these companies have a very strong existential incentive to legally manage and smooth out how that depreciation hits their public books.
Which leads us directly to the maneuver that the sources are calling the magic trick.
The spreadsheet magic trick.
This is the specific pivot that is making forensic accountants and financial analysts so incredibly nervous right now. Think about the timing here. Right at the exact historical moment when AI hardware is becoming technologically outdated faster than at any point in computing history, again, remembering that the physical reality demands rapid replacement, what are these tech giants actually doing on their financial statements?
They're doing the exact opposite.
They are doing the exact opposite of what the physical reality dictates. The sources detail how these hyperscalers are artificially boosting their reported net income by simply going into their accounting software and extending the assumed useful life of their massive server farms.
Precisely. The source notes the specific changes made by the market leaders. Microsoft and Google made the executive decision to extend the estimated useful life of their servers from a standard 4-year life cycle to an extended 6-year life cycle.
They just added 2 years on paper.
So instead of acknowledging the physical reality that a massive cluster of GPUs might be functionally uncompetitive in 2 to 3 years due to the brutal power efficiency requirements of training next-generation AI models, they are officially instructing their accounting departments to spread that massive capital cost out over 6 whole years.
It completely changes the internal math.
It fundamentally alters the reported earnings per share.
Yeah.
And it is entirely disconnected from the physical reality of the silicon they are purchasing.
I want to make sure we are really drilling down into the impact of this, because the source doesn't just offer abstract theory, it gives us a highly concrete, undeniable example of just how powerful this spreadsheet adjustment really is.
And it's a huge number.
Look at Google's public financial reporting. In 2023, Google was able to add a staggering $3 billion to its bottom line earnings.
$3 billion.
Let me reiterate the scale of that. $3 billion in pure reported profit added directly to their books.
Out of thin air.
Now, did they achieve that by inventing a massive revolutionary new consumer product line? Did they suddenly secure a record-breaking number of new premium enterprise cloud contracts?
Definitely not.
No. They generated that $3 billion in profits simply by changing that one single assumption regarding depreciation timelines in their accounting software.
It is, for all intents and purposes, a magic trick for quarterly profits.
It's an illusion.
It allows the hyperscalers to report massive seemingly healthy AI-driven earnings to the market. But those earnings are heavily insulated from the brutal reality of their hardware losing its competitive edge at warp speed in the physical data centers.
And this brings us directly to the bottom line for you, the listener, navigating this landscape.
Yes, why you should care.
What is the immediate productivity, strategic, and business impact of this $680 billion accounting illusion?
Because, as the source accurately points out, corporate accounting can only mask physical reality for so long.
You can't hide it forever.
You can extend the spreadsheet life to 6 years or even 8 years, but eventually that aging silicon physically cannot run the parameters required by the newest, most advanced AI models.
It just can't do the math.
It hits a hard compute wall. And when that happens, the hardware has to be physically ripped out and replaced regardless of what the amortization schedule says.
The bill comes due.
Morgan Stanley's analysts predict that by the year 2029, these delayed, mathematically suppressed costs are going to violently explode onto the balance sheets.
Violently explode.
The financial bill for this unprecedented infrastructure build-out is going to come due. Companies like Oracle, Meta, Google, and Microsoft are going to see actual realized hardware depreciation become a massive, completely unavoidable chunk of their total operating expenses.
So if you are currently acting as an IT director negotiating multi-year vendor contracts, or a startup founder building your product on top of an AI API, or just an enterprise professional heavily relying on automated cloud services, you need to deeply understand the downstream effects of what happens when a company like Google or Microsoft suddenly has to absorb hundreds of billions of dollars in delayed realized hardware costs.
They aren't going to just eat that cost.
Exactly. They aren't simply going to shrug and eat those massive losses out of the goodness of their hearts to protect your operating margins.
They will pass it on to the consumer.
That eventual unavoidable bill is highly likely to result in sudden, severe, and widespread price hikes for enterprise cloud storage, raw computing power, and API access to these AI models.
It has to.
The standard enterprise SaaS subscriptions that your company relies on to maintain baseline productivity could easily double or triple in cost as these hyperscalers scramble to extract revenue to balance their rapidly deteriorating hardware books.
Imagine your IT budget tripling overnight.
This entirely shatters the prevailing Silicon Valley narrative that AI is automatically inherently going to make every single business drastically cheaper and more profitable to run over the long term.
It's a myth.
If the foundational structural infrastructure costs are currently being artificially delayed and smoothed out, your future enterprise IT budget is sitting squarely in the crosshairs of a massive market correction.
That is a vital strategic realization for anyone building dependencies on these systems today. You are currently architecting your company's core operational workflows on top of a digital infrastructure where the true unsubsidized cost of the compute is being actively obscured by creative accounting.
Obscured is the perfect word for it.
But we also have to recognize a structural advantage here. The hyperscalers we just discussed, Google, Microsoft, Meta, while they are playing a dangerous game with hardware depreciation, they possess an incredible safety net.
They have other businesses.
They have other massive, deeply entrenched, wildly profitable legacy businesses to fall back on.
Right.
Google has a near monopoly on global search advertising. Microsoft has the absolute bedrock of enterprise computing with Windows Office 365 and Azure's traditional hosting. Meta has the most lucrative scaled consumer advertising network on the planet.
They print money.
They have an immense financial cushion to help absorb the shock and smooth out the turbulence when that $680 billion bill finally comes due. They can cross-subsidize their AI ambitions with their legacy cash cows.
But not everyone has a cash cow.
Exactly. But that structural reality demands that we ask a much more concerning question. What happens to the companies driving this revolution that possess absolutely no financial cushion whatsoever?
That is the crucial pivot we need to make right now, because we have to transition our analysis from the highly diversified tech giants to the companies that are currently operating in a state of pure play panic.
Pure play panic.
We are talking about the organizations whose entire existence, every single line of code, is dedicated solely to artificial intelligence. And the source material utilizes the ultimate undisputed heavyweight example here, OpenAI.
The poster child.
This is the organization sitting at the absolute epicenter of the entire generative AI revolution. The creators of ChatGPT, the company that effectively kicked off this entire global arms race.
The one everyone is watching.
And if the financial situation looks slightly precarious for the trillion-dollar tech giants with massive safety nets, the sources indicate that the internal financial reality looks downright terrifying for a pure-play company like OpenAI.
Terrifying is putting it mildly.
Let's look strictly at the raw numbers the sources lay out for their current operational year. OpenAI is currently facing over $80 billion in incoming bills and hard contractual commitments to its suppliers.
80 billion.
Let me say that again to ensure the scale registers.
80.
$80 billion. It is an absolute insurmountable wall of required capital just to keep their data centers powered, their talent retained, and their next generation models training.
The sheer scale of that financial obligation for a company that is technically still a startup is truly unprecedented in the history of modern business.
It's mind-boggling.
And to truly contextualize the gravity of that $80 billion wall, the source directly contrasts it with their projected incoming cash flow.
Their revenue.
How does an organization even begin to service an $80 billion operational requirement when they're only projected to generate approximately $20 billion in total top-line revenue?
They are short $60 billion.
It is a massive, gaping structural financial deficit. And remember, as we just established, OpenAI doesn't have a legacy search engine monopoly generating billions in ad revenue, or a global decades-old enterprise software division to quietly subsidize these catastrophic losses.
They just have AI.
They are relying entirely 100% on their current and future AI products to eventually balance this monumental equation. It is a high-wire act without a net, and the math is currently highly unfavorable.
Here's where it gets really interesting because the source material doesn't just drop that massive deficit and move on. It digs rigorously into exactly why that specific gap between top-line revenue and operational expenses is so punishingly massive.
Why are they losing so much money?
It all comes down to a highly technical concept that we need to thoroughly understand: the cost of inference.
Inference.
Now, inference is a term that gets thrown around casually in tech media, but let's define it with the exact operational precision that this source does.
Please do.
The cost of inference is the sheer raw cost of the electricity, the cooling, and the utilized computing power that is required every single time you or I type a prompt into ChatGPT and hit enter.
Every single time.
Every single time. When you ask the model to analyze a complex PDF or rewrite a vital client email or debug 1,000 lines of Python code, the model isn't just pulling a pre-written answer from a static database.
Like a Google search.
No. Massive, incredibly power-hungry server farms are dynamically spinning up, burning vast amounts of electricity and engaging expensive Nvidia GPUs just to calculate the probabilistic output of those words on your screen in real time.
Exactly. And the financial reality that the source material lays completely bare, which is the most closely guarded secret in Silicon Valley right now, is that the cost of that real-time inference, the actual cost to simply operate this service for the end user, is currently vastly higher than the revenue they are bringing in from standard consumer subscriptions and enterprise API usage.
They are losing money on every prompt.
They are essentially operating a massive charity for enterprise productivity. They are heavily subsidizing every single interaction, every single query, every single API call you make to the platform.
Wow.
The more you use the tool to increase your own productivity, the more money OpenAI actively loses on the back end.
That is a wild business model.
And if that underlying structurally flawed business model isn't concerning enough for the future of the industry, the source highlights that the financial picture gets even murkier and more convoluted when forensic analysts attempt to break down where that projected $20 billion in claimed revenue is actually originating from.
This brings us to a highly controversial mechanism that analysts are calling the Microsoft revenue shuffle.
The shuffle.
Now, let me challenge you on this, because on the surface, $20 billion in revenue for a company, this new sounds like the most successful product launch in the history of capitalism.
Right, it sounds amazing.
Why are the analysts in the source material so deeply suspicious about the quality of that specific revenue?
Because in corporate finance, not all revenue is created equal, particularly when massive strategic partnerships are involved.
Okay.
The sources note that financial analysts are looking very closely at the deeply intertwined relationship between OpenAI and its largest investor, an exclusive cloud provider, Microsoft.
They are practically joined at the hip.
They are. The prevailing theory, which is gaining significant traction among auditors, is that a substantial chunk of that $20 billion isn't entirely organic external revenue.
It's not real people paying for it.
It's not just millions of independent mid-market businesses and everyday professionals independently deciding to pull out their corporate credit cards to buy ChatGPT Plus or API access. The suspicion is that a highly significant portion of that revenue is effectively just capital being mathematically shuffled back and forth between the two entities.
How does that work in practice?
For example, Microsoft might invest billions of dollars into OpenAI, but that investment isn't a wire transfer of liquid cash. It's heavily weighted in Azure cloud computing credits.
So it's server time.
Right. OpenAI then spends those credits back on Microsoft's Azure servers to train their models and run inference. Microsoft then potentially records that compute usage as top-line cloud revenue while simultaneously injecting capital to keep the system moving.
That is a loop.
It's a highly complex circular internal financial loop, a closed ecosystem, rather than true independent market validation of the product's unsubsidized standalone value.
That is a staggering implication. If a massive portion of their revenue is essentially just internal accounting round-tripping with their primary benefactor, it means the actual organic demand for the product at its current price point might be a fraction of what is being publicly projected.
It's definitely possible.
But I want to be entirely fair to the companies involved here. Let's play this out using the most optimistic assumptions possible.
Let's do that.
The source makes an incredible point here. They say, let's completely disregard the skeptical analysts. Let's assume the Microsoft revenue shuffle is a myth, and every single cent of that projected $20 billion in top-line revenue is 100% real, completely organic, and originating from unique, independent paying customers.
The best-case scenario.
Exactly. Even with that absolute best-case assumption, the fundamental structural problem of the company does not go away. In fact, the source data shows it is escalating at a terrifying pace.
It's getting worse.
The source walks us through the bleak, unavoidable financial projections. Even in a best-case scenario with massive revenue growth, OpenAI is projected to suffer a staggering $5 billion operational loss in 2024.
$5 billion.
And here's the metric that should send shivers down the spine of any investor. That loss is projected to massively balloon to an $8 billion loss in 2025.
$8 billion in losses.
The financial hole they are digging isn't shrinking as they scale up and gain millions of new users. It is actually getting deeper, and it is doing so at an alarming exponential rate.
And that exponential loss curve forces us to directly address the bottom line for you, the listener, right now. What is the tangible, real-world productivity impact of this pure-play panic?
How does this affect their day-to-day?
Stop thinking about these companies as abstract tech investments and start thinking about them as vital cogs in your daily professional workflow. You or your engineering team or your marketing department might have completely structurally integrated ChatGPT or a similar elite LLM API into your core business processes over the last 12 months.
You're using it every day.
It is actively helping you write code faster. It is drafting your external communications. It is synthesizing your complex market data. The absolute flagship AI tool that is currently driving modern professional productivity across the globe is operating inside a massive, rapidly escalating financial crater.
That is a terrifying thought.
As a professional building dependencies on these systems, you have to critically ask yourself, how reliable, how permanent is this infrastructure?
Will it even be there next year?
You must realize that the current era of incredibly cheap, relatively unlimited high-speed access to these elite world-class AI models is a historical anomaly. It is heavily artificially subsidized by venture capital and hyperscaler balance sheets.
You are not paying the real price.
You are currently not paying anywhere near the true, raw, physical cost of the compute service you are consuming.
Which means we are essentially living in an artificial bubble of hyper-productivity.
A complete bubble.
It reminds me of the early days of ride-sharing. Remember when you could get a premium black car across a major city for $8 because venture capitalists were heavily subsidizing the actual cost of the driver and the vehicle to aggressively capture market share?
The golden era of Uber.
Right. It was amazing for the consumer, but the math was always fundamentally broken. Eventually, Wall Street demanded profitability, the subsidies evaporated overnight, and suddenly that exact same ride cost $40.
The honeymoon ended.
We are currently in the $8 ride phase of generative AI. You are enjoying a honeymoon phase of artificially cheap, subsidized intellectual labor. But the math dictates that this cannot last forever.
It mathematically cannot.
If a pure play company is burning $8 billion a year just to keep the servers online and answer your prompts, severe, unavoidable market adjustments are inevitable. And those adjustments are going to directly and painfully impact your daily workflow.
They have to make the money back somehow.
As they desperately scramble to close that massive operational deficit, you might face extreme sudden price hikes for your premium enterprise subscriptions.
Your $20 sub becomes $100.
You might encounter severe API usage caps that throttle your team's productivity right in the middle of a critical software deployment. Or perhaps most insidiously, to save on the crushing cost of inference compute, the providers might quietly degrade the cognitive quality of the model itself, giving you faster, cheaper, but significantly less accurate outputs.
We've already seen whispers of that.
You are currently building your long-term professional reliance on a digital foundation that structurally and financially speaking is highly unstable.
And we need to understand exactly why that instability exists, because it stems from something much deeper and more fundamental than just aggressive Silicon Valley budgeting or a desire for rapid market expansion.
It's not just bad management.
No, it stems from the physical and mathematical nature of the AI technology itself. The sources point out something incredibly profound, a fundamental paradox, sitting right at the absolute heart of the modern AI economy.
The paradox.
It is a reality that completely and utterly defines how we as a society are entirely accustomed to technology operating. In the traditional tech world, think about standard SAW software, or manufacturing smartphones, or deploying a global social network. There's an unbreakable golden rule of economics. The bigger you get, the larger your user base grows, the cheaper each individual unit or user action becomes to facilitate.
Software is infinitely scalable.
It is the classic concept of economies of scale. You pay the high upfront cost to engineer the software or build a platform once, and then it costs you practically $0 to distribute the 1 millionth copy or host the 1 millionth user profile.
Your margins just expand and expand.
Your margins expand exponentially as you scale. But with generative AI, the rigorous data in the sources show us that the exact opposite is true.
This is without a doubt the most crucial paradigm-shifting insight in this entire deep dive.
It changes everything.
AI completely and fundamentally defies traditional tech economies of scale. Think about the stated end goal of these organizations, the relentless pursuit of artificial general intelligence.
AGI.
The race to make these models exponentially smarter, more capable of complex reasoning, and less prone to factual hallucination. To achieve that next level of capability, the underlying physics and scaling laws of AI dictate that you need exponentially more training data and exponentially more raw computing power.
Which is incredibly expensive up front.
But the truly brutal math comes after the model is trained. Once you have built that massive, significantly smarter model, let's say a massive mixture of experts model with trillions of parameters, it inherently requires significantly more compute power, more server memory, and more electricity to generate every single individual answer for the end user.
Every single time you hit enter.
The math is completely unforgiving. Making the core product better, smarter, and more useful inherently means every single question you ask, it costs the company significantly more money to process.
It's an economic structure that operates completely backward compared to the last 30 years of software development.
Completely backward.
In any other digital industry, refining the underlying code base or optimizing the delivery network makes the core product cheaper to operate over time, driving massive profit margins. In the realm of large language models, improving the core technology actively makes the unit economics substantially worse.
The better it gets, the more money they lose.
The bigger, more capable, and more widely adopted these AI models get, the further away from actually generating a sustainable, unsubsidized profit they seem to become. OpenAI is the ultimate, highly visible poster child for this unprecedented economic paradox.
They are the prime example.
Yes. Their top-line revenue is undeniably growing as more enterprises adopt the tool. But because of the massive, unavoidable physical cost of inference and the complete lack of traditional software economies of scale, their massive operational losses are scaling up even faster than their revenue.
They can't outrun the costs.
And this intense compounding financial desperation leads directly to the user experience. When the math doesn't work, the product has to fundamentally change. It leads directly to the pivot.
And this brings us to a breaking development that directly and immediately impacts every single user currently relying on these platforms.
It's going to affect everyone.
The source material recalls a very specific, highly publicized previous statement from OpenAI's CEO, Sam Altman. In the earlier days of the platform's explosive growth, he explicitly stated that introducing advertisements into the ChatGPT interface would be an absolute last resort.
He said they didn't want to do it.
It was viewed by the community and the company itself as entirely antithetical to the core premise of the product, a clean, highly productive, objective, trustworthy digital assistant that works solely for the user.
You ask a question, you get an unbiased answer.
But the brutal financial reality we have just spent the last 40 minutes rigorously outlining the complete lack of software scaling the looming $80 billion operational wall, the massive, unyielding physical cost of server inference, has apparently forced their strategic hand.
The math caught up with them.
The source delivers the factual, undeniable twist that is going to reshape the industry. Ads are officially coming to ChatGPT.
Which is a monumental shift in the deployment of this technology. We are talking about the introduction of an advertising model to the core foundational productivity tool of the decade.
It changes the entire nature of the tool.
And the source material makes a very stark analytical conclusion regarding this pivot. The introduction of an advertising revenue stream mathematically proves that the core product, as it is currently priced and utilized by the market, simply isn't inherently valuable enough for users to willingly pay its true unsubsidized physical running cost.
People wouldn't pay what it actually costs to run.
If the product generated enough undeniable ROI for the average user, they could simply raise the subscription price to cover the compute costs.
Just charge $50 a month.
But the internal data clearly shows that the standard $20 or $30 monthly subscription revenue alone, mathematically, cannot bridge the massive gap created by the daily inference costs of power users.
So they have to turn to ads.
Therefore, they are entirely forced by market mechanics to find alternative, potentially intrusive ways to aggressively monetize their massive, highly engaged user base to keep the servers running.
Which forces us to look squarely at the bottom line regarding the immediate productivity and security impact for the average professional relying on these tools.
This is where it hits home.
Think deeply about what an explicitly ad-supported, ad-driven AI actually means for the integrity of your daily professional work. If you are currently using ChatGPT as a high-level research assistant to quickly synthesize complex market information or summarize massive data sets, an ad-driven model could drastically and negatively alter your core productivity.
You're going to get distracted.
Will the clean, efficient interface become aggressively cluttered with sponsored widgets actively slowing down your cognitive workflows? But more importantly, we have to look at the structural integrity of the output itself.
You can trust the answer.
Exactly. How will an ad-supported AI prioritize the information it feeds you? If the model's revenue depends on serving sponsors, will the results it generates for your critical queries become subtly biased, skewed, or manipulated to favor sponsored paid content over the most empirically accurate, objective answer?
That is the big question.
Let's say you are an IT director asking the model for an objective analysis of the best enterprise CRM software for your specific use case. If the AI company's revenue is heavily supported by CRM companies actively buying high-priority ad placement, can you ever truly trust the objectivity of the output?
You really can't.
The core utility of the tool as an unbiased analytical engine is fundamentally compromised.
That is a massive, immediate productivity concern that fundamentally alters the value proposition of the tool. But the enterprise security and data privacy implications are even more immediate and potentially catastrophic.
It's a huge risk.
If you are a modern professional heavily utilizing these tools, you are constantly feeding the AI highly specific, highly contextual prompts. You might be pasting in thousands of lines of proprietary code snippets to debug drafting highly sensitive internal executive emails regarding upcoming mergers, or asking deep strategic questions that clearly reveal your company's immediate market focus and vulnerabilities.
You are giving them your secrets.
Currently, you operate under the assumption that you are paying a subscription fee for a secure, private computational utility. But if the AI provider's primary revenue stream abruptly shifts from your standard subscription fee to a massive global advertising model, their entire corporate incentive structure changes overnight.
They need your data to sell ads.
They have to fiercely monetize your attention. And to serve highly lucrative, highly targeted ads to enterprise users, They are fundamentally required to monetize your operational data.
They have to read your prompts.
This raises immediate glaring data security questions about exactly how your highly sensitive daily prompts are being actively analyzed, categorized, and potentially utilized by back-end algorithms to build incredibly detailed targeting profiles for external corporate advertisers.
That is a compliance nightmare for any enterprise.
The tool you confidently thought was a secure, isolated digital assistant is suddenly structurally functioning much more like a highly invasive, enterprise-grade social media data broker.
So what does this all mean? We have covered a massive, incredibly dense amount of analytical ground here today, looking strictly at the raw financial, physical, and architectural foundations of the current AI boom. We've gone from the macro level of hyperscaler balance sheets down to the micro level of individual GPU inference costs.
It logically leads us to the ultimate overarching industry dilemma, which the source material frames perfectly based on every single rigorous fact we've discussed today.
The big question.
If the fundamental physics of the technology dictate that making AI better and smarter inherently makes it exponentially more expensive to operate, and the current highly celebrated business models are currently buckling under the immense, unavoidable weight of physical hardware depreciation and relentless inference compute costs, we have to ask who actually captures the real, sustainable, long-term economic value in this supposed trillion-dollar technological revolution.
Who makes the real money?
Is the true value going to be captured by the highly visible companies actually building these amazing world-changing foundational models? Companies like OpenAI or Anthropic, who are doing the incredibly hard, groundbreaking intellectual work, but are mathematically forced to operate at massive, escalating, potentially unsustainable losses.
Are they going to survive?
Or is the true underlying economic value of this entire era being entirely disproportionately captured by the companies simply selling the shovels in this modern, highly capital-intensive gold rush?
The hardware guys.
We are looking directly at companies like Nvidia, who are selling the critical, indispensable physical hardware that becomes technologically obsolete so incredibly fast that it requires constant, massive, multi-billion-dollar repurchase cycles from the increasingly desperate model builders who have no choice but to buy the newest chips just to stay relevant.
That right there, the dynamic between the model builders bleeding cash and the hardware manufacturers printing cash, is the literal trillion-dollar question defining the next decade of technology.
It really is.
The people building the vital shovels are currently making a historic, unprecedented fortune, while the people aggressively digging for the digital gold are drowning in massive operational debt, structural deficits, and highly complex accounting tricks just to keep the operation afloat.
It's a completely lopsided economy.
It's time to bring all of this complex analysis together for you. We promised you a rigorous TLDR to cut through the industry noise, and here are the three most important, undeniable takeaways from this entire exhaustive deep dive.
Number one.
Number one. The massive tech giants, the hyperscalers controlling the global infrastructure, are actively utilizing perfectly legal but highly questionable depreciation accounting tricks, specifically extending the assumed useful life of their physical servers on paper to temporarily hide massive impending hardware obsolescence costs and artificially boost their current quarterly profits to satisfy the market.
Yeah, number two.
Number two. The pure-play AI companies, with OpenAI serving as the prime, highly visible example, are currently operating at massive, rapidly escalating financial losses because the fundamental physical cost of inference, the raw electricity and computing power required to actually process and answer your daily prompts, vastly outpaces their actual organic subscription revenue.
Oh, the final one.
Number three, the fundamental physics of generative AI completely defies traditional, highly profitable tech economies of scale. Improving the underlying models actively makes them significantly more expensive to run per user query, leading directly to user-impacting, financially desperate monetization moves like the impending, highly disruptive arrival of targeted advertisements directly into the ChatGPT interface.
Those are the cold, rigorous facts drawn directly from the financial data in the source material. Today, we've actively stripped away the relentless marketing hype to show you the incredibly volatile, highly precarious accounting reality churning underneath the surface of the boom.
And if you want to stay consistently on top of this rapidly shifting, highly complex landscape and ensure that your team, and your enterprise IT budget are never caught off guard by the sudden economic realities of the tech industry, you need to maintain this level of rigorous analysis.
You have to pay attention.
We explicitly remind all of our listeners to head over and check out the Tech News TLDR YouTube channel. We post highly detailed, high-energy daily video updates breaking down exactly these kinds of crucial paradigm-shifting topics. Subscribe over there so you never miss a vital market beat.
It's essential watching.
Now, as we wrap up this extensive analysis, we want to leave you with one final, lingering, highly provocative thought to mull over as you return to your daily workflows.
Think about this.
Based purely on the unvarnished financial facts and physical compute realities we've extensively discussed today, if the foundational financial architecture of our incredible, highly efficient new AI-driven workflow is actually built on a massively delayed accounting bill and heavily unsustainably subsidized hardware costs, what exactly happens to your daily operational productivity and your company's bottom line software budget when the global tech industry is finally inevitably forced by the laws of physics and finance to balance its checkbook?
It is a question you need to ask yourself today.
Think very critically about that the next time you casually type a prompt into the interface. Thank you for diving deep with us today.